Good day, I'm Chartered, your accounting tutor. In today's video and class, we are going to continue on financial statements of a sole trader. Mind you, we have already treated under the financial statement. We have already treated statement of profit or loss and other comprehensive income in the other class. Today, we are going to continue to look at statement of financial position of a sole trader. What do you mean by statement of financial position? Statement of financial position is a statement that is prepared to summarize the assets, liability, and equity of a sole trader. It's a statement that is prepared to determine the total assets, total liabilities, and equity of a sole trader, which must be equal. That is what we have accounting equation. Statement summarizes what is called the accounting equation or proof what is called the accounting equation, whereby capital plus liability is equals to assets. Capital plus liabilities is equals to what? Assets. So the statement is all about trying to bring out that equation, trying to detail out all the assets of the business plus its liabilities, which must be equal to the assets. So that is what the statement is all about. So the statement is divided into sections, just like the accounting equation defines it. Here we have the assets, we have liabilities, and we have the equity. So we want to understand each of the sections, what is all about. The first one is assets. What are assets? Assets are resources or values owned by the business which will be used for future benefit to generate income. Assets are resources or any value owned by the business which the business used to generate future benefits. These assets are divided into two. Number one is what is called the non-current assets, which was hitherto called the fixed assets. Number two is current assets. Current assets, or you can also call it the liquid assets. So let's look at what are the examples of non-current assets. By the way, what is non-current assets? These are assets owned by the business to be used for future benefits, that their benefits must be more than 1 year. That if you acquire it or you own it, the benefits of the assets will be used, will be derived by the business for more than a year, at least from 2 years and above. But if it's less than 1 year, then it is grouped under what is called the current assets. Let's quickly look at the examples of non-current assets. Number one, land. It is obvious that if a business acquires land, thank God that you know that land can last as long as the kingdom come. So the value of the land will be derived by the business year in, year out. And land doesn't depreciate based on the nature and understanding in accounting. The next example we have building. Building, when you construct any building or acquire any building, at least the value more than a year, which is 2 or more, depend on how the building is. But here, the building can depreciate, but all we know that the value will be more than 1 year. Next, we have machinery, big machinery used by factories, by companies for production. If we acquire them, their value is more than 1 year. We have motor vehicle. It's obvious that any motor vehicle purchase cannot just finish in 1 year. The value will be there more than. These are some of the examples. There are more than this. We have up to 20 or 15 different non-current assets used in accounting. But the only thing that you know is that the definition is clear. Any non-current assets acquired by the business, the value must be more than 1 year used by the business to derive future benefits. So these are some of the example of non-current assets, which was hitherto called fixed assets. Next, we have what is called the current assets. What is current assets? Current assets are assets acquired by the business that the benefits are derived within 1 year. That is, these assets change their value. They can be changed. Their value change within a year. You can get them now, but in less than 1 or 2 weeks or months, the value will change. For example, you will have cash in bank. Before you know, you can use the cash to acquire current assets, or you can even use the cash to buy something. The cash will not be there permanently for a whole year. The same thing to bank balance, inventory. Inventory and merchandise goods purchased by the business for resale. You could have a lot of inventory in store today. By 1 month or 2 or thereabout, the inventory will be sold and turned to cash. And that is what we say. Non-current assets are assets acquired by the business that their last span is less than 1 year, which means they can change their value anytime within the year. They cannot just be there stock for more than a year. So if their value is within 1 year, then we refer to them as non-current assets in accounting. What are the examples? Number one, we have to call inventory. Inventory are goods purchased for resale, what we call merchandise goods. Hitherto it was called stock. With the appropriate term used in accounting that is called inventory. Next, we have what is called account receivable, which was called debtors. These are the money owned by customers to the business. So all the amount owned by customers to the business, those that own that amount are referred to as debtors. Then the right name now become account receivable, hoping that the business will recover the amount from them as they receive it. Next is bank balance. The money in the bank account of the business is referred to as bank balance, which is also current assets and cash, and other things like prepayments and other things that relate to the use in the business that is within 1 year. So here we have finished the first section of financial statement, which is that of the assets. Let's go to the second one, which is called liabilities. What are liabilities? Liabilities are the money owned by the business. That is the amount of resources owned by the business to outsiders. They are claims on the assets of the business. That is, the business owns outsiders such money in respect of either cash or goods or anything. So if they are yet to repay, then they refer to as what? Liability. They also refer to as claims against the assets. For example, if you own somebody 10,000 for goods purchased, then it means if you cannot pay, the person can come and claim any of the assets for his money. And that's what we say, that liabilities are claimed against the assets that the business have. That is the appropriate thing. That is the money that the business owns outsiders, which become a claim on the assets of the business. So what are the types of liabilities? Now, number one, we have what we call non-current liabilities. Non-current liabilities are liabilities that the business owns in which their repayment period is more than a year. That is the time the business is going to repay. That is the duration for repayment or the obligation to repay it. The time frame is more than a year. Just like loan, you borrow a loan and I'm asking you to pay in 2 or 3 years' time, you know that it becomes a non-current liability. It's not within short time. It is either 2 years, 3 years, or what have you. So, what are the examples of non-current assets? Number one, we have loan. I already explained. Loan can be titled, even if it's within 1 year, somebody calls it loan. But in accounting, if you mention the word loan, the first thing that will come to your mind or should come to learner's mind is an amount owned by the business that the repayment is more than 1 year. That is when you talk of loan. But just if it's within 1 year, you can term it borrowing or owing or anything. But in accounting, the word loan qualify any liabilities that the business owns that is more than a year. So the next one called debentures. These are means by which company get money. Just give an example. They might not be applicable in one-man business, but just for learners to know some of the examples of non-current liabilities. Debentures are means by which companies issue out certificates to people and collect money from them with interest to be paid back. The repayment surely is more than a year. Bond is just like debenture. These are also certificates of borrowing given to the people that are giving the money so that they will pay them back at a long time. Government even use bond, which sometimes are 5 years repayment period, 10 or even more, depending on the case may be. So these are called non-current liabilities and preference shares. Preference share in total was referred to as capital, but currently it's referred to as a non-current liability because though it is capital, but it has a fixed interest which must be paid within a definite period of time. So if we say preference shares on the company account or anything, know that it is a non-current liability. Before it was capital. Let's go to the next example of liability, which is the current liabilities. These are liabilities that the business owns, which the repayment period is within 1 year. Which the repayment period is within 1 year. goods purchased for resale, where we say goods purchased on credit by the business. It is expected that the amount should not last, the repayment period should not last more than a year. So account payable, which was hitherto called creditors, is referred to as the current liabilities. The next is bank overdraft, whereby the business take money out of the bank and then promise to pay within a short period of time. That is, the business withdraw money from the bank more than what the business was having in the bank. So short is then the current liabilities, and the repayment is always very short with a very high interest of payment. Next is accruals or owing. This is just general owing on expenses incurred by the business, like the business supposed to pay electricity and they were unable to pay within the time period. You can refer to as accruals, or you can call it owing. Or the business supposed to pay insurance or any small debt to the business owned due to services. They are all grouped as accruals or what? Owing. But mind you, the repayment is within 1 year. So these are the examples of what we call current liabilities. Let's look at the last section, which is called equity. What you refer to as equity. Equity is what is the owner, the owner's stake in the business. Equity is the owner's stake in the business. What belongs to the owner in the business. Mind you, equity is there because of what we call business entity concept, whereby the owner is different from the business. So the assets and liabilities of the owner are different from that of the business. So business entity is telling you that as the owner invests into the business, there's other benefits that the owner is having in the business. So what belongs to the owner in the business is what is grouped under equity. So let's look at equity. What is equity? Number one, we have capital. Capital is the initial amount invested by the owner, or the owner put the capital into the business. It's referred to as capital. Capital is divided into what is called the opening capital and additional capital. The opening capital is the first initial capital the owner put or inject into the business to get additional benefit from it, to get what is called interest. Then the next one is what is called additional capital, which is the capital that the owner introduced after the initial capital that has been introduced into the business to boost or add the strength of the business. The next example of equity is what is called profit or loss. Profit or loss here, we are saying that as the owner put capital into the business, expecting to get interest and also get profit, what is called gain. So if the profit comes from the trading activities of the business, the profit will go to the owner. It can either be profit or loss. This is also under the section called equity. Next, we have what we call reserve. Reserves here are the profit that the owner gets, but he does not want to spend it all. He has to return some of the profit to make the business to grow. So we refer to them as reserves, which in a company account we have different types of reserve. With the common one, we have what's called the general reserve and the revenue reserve. But all we know that the reserve is the owner, because it's after the profit that the owner removes some, not to spend, but return it to the business for future benefit or to allow the business to grow. So it is under equity. Last but not least, we have what is called the drawings. The drawing is what the owner takes out of the business for private use, because the owner has the right to take something from the business for private use because it is his own business. So he can decide to take money out of the business at any time, but as he takes it in accounting, you must acknowledge it because of the business entity concept. And in drawing, we have basically two types of drawings. It's either the owner takes money takes something out of the business in form of cash or in form of goods. So these are the common drawings that is taken out of the business for private use. So in this case, this now comes the common items you can see under what is called equity. It is now clear that in accounting, when capital that was introduced by the business plus all the liabilities, if all things are equal, must be equal to the assets of the business. So these are the sections that we have under statement of financial position of a sole trader or even any company. So please don't forget to like, because this is just a continuation of this. We are going to draw out the format of how to arrange or prepared statement of financial position, the format arrangement as it is, you must arrange it in the way it's supposed to be so that at the end of the day, the two sides will be what? Equal. Don't forget to like my video, comment, and ask any question. Share the video because I'm here to make sure that I give you the detailed explanation of what is found in all these statements. Like my video, comment, and share so that the knowledge will continue to grow for more learners to understand. I'm Chartered, your accounting tutor.